Hello everyone, welcome back to the channel. Hope you've been well. Today we've got our regular bi-weekly update, and I will also at the end of it talk about a stock that I think has some really good potential moving forward. As always, leave a like if you enjoyed it and subscribe, and feel free to share with anyone that might benefit from some of these videos. Without further ado, let's get started. Alright, so the last couple weeks, the market has been doing alright. There hasn't been a whole lot of movement. We've seen more of a movement in terms of price appreciation towards those value stocks again, which are usually those large cap companies or more stable plays. The growth stocks have taken a hit, especially this week as I'm recording, which is about April 17th to the 24th. So the growth stocks have really kind of been fluctuating a lot more as far as the daily spreads, which, we'll go over a couple stocks in particular that kind of showcase exactly how the growth stocks have done versus the more stable value plays. But as you can see, the portfolio as a whole is doing fine. There hasn't been much movement on the US side of things overall. After about 2 weeks, we've seen slight price appreciation, but not much. And as for the Canadian portfolio, you've seen a bit of an uptick there. Moving over to the graph, you can see this is the Canadian one. We're still showing a nice upward to the right momentum, even though there's been some up and downs, of course. And for the US one, certainly quite a bit choppier. And as you can see, we're actually still quite a bit away from that original high that we hit back in February. So I'll go over kind of a couple charts later on today where we're taking a look at the broad market as a whole, because the indexes have actually been doing quite well so far this year. And that's mainly because, like we said, there's been a bit of a shift towards those plays, and those larger cap companies, if they're doing well, the index as a whole will do well since they make up more of the index. So if we start off with the Canadian holdings, there hasn't been any change as far as the type of stock we've held. I haven't bought any new companies or anything like that since the last 2 weeks. I have added to BRP, which is that company, which is a subsidiary of Bombardier that makes the automotive toys such as ATVs, motorbikes, jet skis, that kind of stuff. As I still feel like I think over the next little while, even as things open back up, people want to go on vacation, they might have some money saved up, and they might start picking more local destinations as far as getaways. So overall, mostly everything in this portfolio is up. You will see, of course, and this is what I mentioned, the growth stocks are still getting hampered a bit. Shopify, even during the last couple of weeks, at one point was up to around $1,500 some odd dollars, and this week has really come back down. And Well Health Technology is very similar. If I had recorded this about a week ago, you would have seen, significantly higher price points. But that's the game when we're playing in the stock market. I do have a bit of cash there, so I will be planning on using that probably sometime in the next upcoming weeks. I imagine by the next portfolio video, this cash will be used up and it will be invested in either one of these or something else. Now, moving over to this US growth portfolio, let's take a look at some of the indexes first. So if we're taking a look at the index as a whole, most of my stocks are obviously listed under the NASDAQ because they're more technology oriented. So if we take a look at the full screen of the NASDAQ, let's take a look at the year to date. As I mentioned, as you can see, correlating exactly with how it's going, the portfolio back in February was at, kind of its all-time high, and that's also where the NASDAQ was at the all-time high. And then since then, it obviously took a large dip, and it's come back up since then. Now, interestingly enough, even though the index itself has come back up, and you're actually seeing, it's not too far away from its high back in February, my portfolio, obviously, if we take a look back at the portfolio, we're still, quite a ways off, right? We're maybe about 5-ish% off between this number here and the high back there. So that's kind of interesting, right? What if I'm buying stocks in the NASDAQ portfolio and the NASDAQ is doing so well, what is really driving the growth in the NASDAQ? That's really important as a trader to really kind of dig into, because is it the companies that we're picking maybe aren't actually good companies, or is there a particular sector that's doing well, and maybe is that the sector that we should be in? Those are all important questions to ask when you're comparing the performance, because as a trader and as an investor, you're buying into the company, so you're looking at the long-term outlook. But it's also really important to check yourself, right? Check, is this really, these assumptions that we would have had when we invested in these companies, are they still accurate today? Or perhaps are adjustments required, right? Because the high here of 14,095, currently it's at 14,016. We're talking less than a percentage point difference between all-time high and the current index. And so if we go back to the point of, well, what is driving these prices, right? Well, let's take a look at the portfolio. This portfolio is mostly growth focused, obviously, as we've discussed, but they're split between, the large mega cap companies. We're talking the Apples, the Microsofts, MasterCard, Visa. These are obviously the largest cap usually in my portfolio, and Taiwan Semiconductor, versus some of the more growth-focused stocks like Appian, right? Appian's down quite a bit. Coupa's down quite a bit. Fubo TV has had a very volatile last, maybe week and a half. So if we take a look at these stocks, you can see that there's actually a trend that's happening, and not so much specific stocks that are not doing well. So if we pull up, let's say Microsoft, right? Microsoft's a large mega cap company. It's the second largest company in the world. When we pull it up here, you can actually see, if you look at the year to date of Microsoft, back in February, it was actually 242, 245. Now we're actually up to 260, right? So the price of Microsoft is actually higher than it was back in February. And because Microsoft is such a huge company and it takes up such a large part of that NASDAQ index, it'll really pull that index upwards, right? And if we look at Apple, another, obviously the largest company in the entire world by market cap. Back in February, the price of Apple was actually very similar to what it is now. You're seeing 134 back on that date, March 12th. This is 135 and 133. So it's actually very close to where it was, right? And that speaks, once again, it lends credence to how the index is doing. Take a look at the other one we had, MasterCard, right? Same thing. Back in February, it's actually 340, 350. Now we're actually looking at 387. So these large cap companies, these huge, ginormous companies, have actually pulled the index up because there's been a rotation away from those smaller cap companies into these large cap. Why? Well, we talked about it before in a separate video. Interest rates being one. You take a look at risk-adjusted returns because of the interest rate. So if the interest rates are higher, people want to take less risk, right? Because they can get a higher guaranteed rate of return just by leaving their money in the account, in the savings account, and that trickles all the way up to stocks. If we look at February here, Appian was 216. Now we're down to 129, right? We're seeing an almost 50% reduction in the price of this stock. And so you think, oh, is it just this stock itself? Well, no. If you look at any other type of growth-focused stock, CrowdStrike is one that has actually held up decently well. But even if you look at this company, back in February, significantly higher than it is now. Not a huge bunch. Like I said, it's held up relatively well, but we're still looking at a 10% haircut. And you can pick any other type of, growth company in here. You look at Fubo, right? That was one of the coin flip companies that I talked about. Very, very heavily growth focused. Back in February, $46. Now we're down to $20. So we learned that the market is doing a sector rotation as a whole. What does that mean for you as an investor, right? Well, as I have said many times, we're investing in companies and we're investing for the long term. So what do? You buy these at a discount, right? If you believe in the company long term and you believe in the long term outlook of your company 5 years, 10 years down the road, this is where you really try and accumulate those shares for cheap, stay firm with your resolve, and then when it starts to rotate back into that sector or that industry, then that's when you can really make your money. So my outlook as I move through this is I'll be holding through the sector rotation. As I add funds to this, what I will be doing is what I've been doing all along, which is continue to accumulate positions in stocks that I believe in. So most likely, as it goes on, Roku is one that I'll be adding to. PayPal, even though I'm making good money on, I will be adding to this one. Palantir is another one. Pinterest is another one that I have very high conviction in. So these are companies that I'll continue to build up and continue to add. Pinterest, I've actually been really dying to put money in. There was a time this last couple weeks where it came down to around the $70 mark. And I personally just got a little bit greedy there, as it came back down to 71.32, and I really wanted it to drop below $70 in order to put my my next buy in. But unfortunately, it's rebounded. Fortunately or unfortunately, I guess it's rebounded a bit since then, so I haven't been able to enter another purchase order for this one. But rest assured, if it ever comes down to test the $70 mark, I will definitely be adding more. Now, the company that we're going to be taking a look at today, actually, which is very high on my watch list, is Disney. And Disney is a very interesting company because you would think that Disney would be a stock that is considered a value play, right? They're very well known for their movies, their entertainment, their parks. But they've made a really amazing pivot to their business since COVID began. You can see, back in November of 2019, 2018, right? It was steadily doing its thing, not a huge movement. It traded in a very similar range from $111, $100 to $100. It pays a regular dividend, and it's a dividend aristocrat, meaning it increases its dividend, or it's historically increased its dividend every single year. And so it pays you for holding their stock. And back during COVID, it hit a low of $85, right? Because all the parks were closed. So the market goes, oh, wow. Well, how is Disney going to make money? And they had been building the Disney Plus channel in the works for a few years. And finally, they decided, oh, it's ready to launch. And so they launched it actually around COVID. And since then, it's had very good reception from the mass market. And they've grown that Disney Plus subscriber list considerably, where you start to wonder if now they're going to be fully taking on Netflix as a video streaming platform. And so you've seen this meteoric rise from back when it was around 120, 127 back in September, August, and now we're up to about 180. And it actually hit a peak of, it won't show here, but it crossed $200 back a little while ago. Oh, no, I'm back on. Well, that's right. There we go. Crossed $200 back just about a month and a half ago. And surprisingly, the stock market has actually started to view Disney as more of a growth play. And so funds have actually started coming out of Disney, as you can actually see by the trading volume here. And this will be a really interesting play going forward. And it's something that I want to do a bit more of a deep dive into, because they've got obviously a really strong foundational base with their entertainment industry and the parks. And Disney's reputation is through the roof, right? Every kid loves Disney. And as you grow up with it, you're still a huge Disney fan, even when you're older. And then you start introducing it to your kids and so on and so forth. So as a value play and a dividend play, it's a really amazing play. But now that they're starting to introduce other lines of business into their business, essentially, and you're seeing the growth opportunity, Disney is placed in a very interesting spot where they have great core foundational cash flow, and they're obviously a profitable business, but you still have a really high ceiling, and you can't tell exactly where the ceiling is because they're able to currently grow their new line of business so well with Disney Plus. And as Netflix has shown, where if you just look at the Netflix stock chart, it's an amazing growth play, right? 5 years, Netflix was $100. Now it's $505. So Disney is a very intriguing business right now to try and create a value. Now, if we take a little bit of a deeper dive into the Disney company, at least that's what I've seen. Basically, back in the company's most recent quarter, right, so ended January 2021, it actually reported a 22% decline in revenues, meaning it's done 22% less sales. Obviously, a lot of that had to do with the parks. And prior to the pandemic, these parks and experiences roughly accounted for 38% of revenues and almost 46% of profit back in 2019. But during the first quarter of this year, that same segment only accounted for 22% revenues and obviously reported a net operating loss of $119 million. So where it's really coming from now, as far as the growth factor of this, is Disney Plus, right? Disney is starting to open up. Walt Disney World and Shanghai Disney were open for the entirety of that first quarter, as well as other parks that were reopening. And Disneyland is actually slated to open back up April 30th, but only with about 15 to 35% capacity. So what's really cool is you see that after 16 months, Disney Plus has already topped 100 million subscribers. And to put into context how crazy that is for growth, they actually originally only estimated, back when they launched this service, they estimated a goal of 60 million to 90 million by 2024 by 2024. So they gave themselves roughly a 5-year timeline to hit 60 million to 90 million subscribers. And now, by January, they had already topped 100 mil. And since then, they've actually reforecasted it to be 230 to 260 million subscribers by 2024. And if you compare it with, obviously, the largest streaming company that we have now, which is Netflix, they just recently reported earnings and they had about an 11% decrease in share price because they actually had very slow subscriber growth for the first time in a really long time in Netflix. And their entire subscriber base is 207.6 million, according to them. That's global. So basically, Disney is already forecasting more subscribers than Netflix in 3 years, obviously comparative to now. And Netflix will certainly grow, but the pace at which Disney has really come on with their Disney Plus service is really impressive. And because of that, Disney is really going all in on these TV shows. And the best part is, compared to Netflix, Disney has a bunch of IP, right? They've got a bunch of intellectual proprietary platforms and technology and service and patents, most importantly, that they can use to create these film and TV projects. And Disney is ever expanding, right? So what they're really trying to do is they're really trying to sell the Disney Plus service, and they're creating a bunch of these shows, and they're making them go directly to Disney Plus instead of going, to a different platform. So it'll be really interesting to see how Disney grows, especially the Disney Plus platform. And once their parks come back and you get that additional revenue from those parks, plus the growth of Disney Plus, it'll be really interesting to see what kind of company Disney becomes, 5 years down the road. For me, I think that this is a really interesting play because the Disney stock has actually sold off a little bit. It's come down about 10% since its high just about a couple weeks ago. And because it pays a dividend every quarter, to me, it's a very interesting play. I think, if I were a betting man, which since I do stocks, you could probably say I am, within the next 12 months, Disney will most likely be added to this portfolio. There's too much to like about it, and the fact that it's had a recent haircut on the valuation makes it a pretty attractive offer for a long. Well, that'll wrap it up for this week's video. As usual, if you liked it, please leave a like and subscribe. And in 2 weeks' time, we will have another regular bi-weekly update. And obviously next week, I'll do something a little bit more on the educational side to help people with their personal finance. Thanks all.